We are in a tornado of a housing market, and it's hard to know who to listen to because all of this is presently happening right now. Us Americans, we are contradicting ourselves. Mortgage rates are hitting 4%. Americans are in the most debt ever. There are fewer homes on the market. And we are going to talk about all of this as well as an update on foreclosures and what I truly believe will be the main thing to watch out for as it pertains to the housing market as we go further and further into 2022. This should not come as a surprise to any of you. We Americans are full of contradictions. Yes, I say we. We say we want to be healthy, but we refuse to put down the French fries. We say we want smaller government and for them to get out of our lives, yet we pick political candidates based on what they are going to tell women they can or cannot do with their bodies. We say we want better schools for our kids, but we don't want our taxes to increase in order to pay for the better facilities and to adequately pay teachers. So when I saw this article that headlined, "A record low number of consumers say that now is a good time to buy a home," I couldn't do anything but smile because us Americans, we are going to American. And oftentimes what we say and what we do not line up with each other. And it's no different in the housing market. Yes, pending sales were down 6.9% compared to a year earlier, but that's only because there are a record low number of homes available for sale. Purchase mortgage applications have declined 12% year over year, but again, that's because of a lack of inventory. And if you ask anybody in the market right now that is looking to buy a home, they will tell you that the only reason they have not gone under contract and bought a home yet is because they've been outbid by other buyers. In actuality, people believe that now is a good time to buy a home because they want to do so before the interest rates go up any higher. Also, the increase in rental rates are pushing a lot of people to believe that buying is a much better option at the present moment. In a video coming out next week, I'm going to address how the median home price in America has actually decreased, which is welcome news to a lot of people. So be sure to subscribe to the channel and hit that bell icon so you can be alerted when I drop that video. Now let's talk about mortgage rates. In the past week, mortgage rates have increased to the highest levels they've been since 2019. Interest rates right now are right at 4%. That's if you don't buy down any points. And everyone is freaking out quite a bit. But in reality, a 4% interest rate is still very low when we compare today's interest rate to rates prior to the pandemic. I recently did a live stream with Joy Bailey, and we talked about how the increase in interest rates and how it impacts your monthly mortgage payment. I'll link to that video in the description. But you may be shocked at how a 0.5% interest rate increase may impact or doesn't really impact your monthly mortgage payment. It all depends on how you look at it. Hello family, real quick to those of you who are here for the first time. I'm Sir Ashley, and on this channel we talk about money, real estate in the Carolinas. And while you're watching this video, if you gain any value from it, go ahead and hit that like button and consider sharing this video with someone you know who's thinking about buying or selling a home in the near future. Now back to mortgage interest rates. In the past 6 months, the mortgage interest rate has gone up almost an entire point. But even with that, people find that it is more cost effective for them to buy a home right now than to pay crazy, outrageous rent prices that could potentially go up year over year. Recently, there was a headline in the Wall Street Journal talking about consumer debt rising to rates highest since 2007. And after seeing that headline, it triggered thoughts of the financial crisis and recession from 2007, 2008, and 2009. But if you read the article, it highlights that the fact of the delinquency rate on consumer loans are hovering near record lows. It also points out that 87% of the increased consumer debt is because of home mortgages, and that the American home buyer today is in a better position than they were in 2007. Additionally, one of the last lines in the article, they kind of snuck this in there, they shared that Americans' credit card balances are significantly less now, or at the end of 2021, than they were when the pandemic started in 2019. I want to hear from you, so please leave a comment below. Are you in a better position financially now than you were at the beginning of the pandemic? Or is your financial position worse presently as compared to the beginning of the pandemic? Please trust me, there will be no judgment whatsoever. I'll be the first to answer the question. The pandemic forced me to sit the down. Literally, everything was shut down. I couldn't go anywhere. So I had to focus on what was important and to stop the unnecessary spending. But I understand that not everyone is in the same position that I am in. That is why I want to hear from you. Because I'm also thinking about making a video and doing a live stream on the topic and answering the question, is home ownership possible today for today's middle class? And we're also going to look at what is middle class today. Since I talk about real estate and we just got done talking about money and finances, that leads us to foreclosures. And for months and months, all we heard about was this wave of foreclosures that was coming to the housing market and how it will cause the housing prices to crash. Well, foreclosure inventory is at the lowest recorded level since 1999. And late payment delinquencies of any kind of late payments delinquencies have dropped to pre-pandemic levels as incomes have grown. So all the people who are sitting on the sidelines waiting for a huge surge of housing inventory due to foreclosures, or thinking that people will need to sell to avoid foreclosure, you can stop holding your breath. You can get off the sidelines because it's not going to happen, and the numbers indicate that. Now, what I do want to point your attention to, and what I believe is potentially the biggest challenge to the housing market in the past 4 years, is the following. Spoiler alert, it is not interest rates. As I said, yes, interest rates will continue to rise, and that will cause some people to bow out of the housing market, but that won't put a big enough dent in the supply-demand equation that's going to cause home prices to stop rising. Now, based on recent history, when the Federal Reserve sells their bonds, the housing market did two things. Home prices did go up, but the volume and pace of home sales reduced drastically. And that may be good news to a lot of you, and to others, that may sound like bittersweet news, and I'll get into why. In addition to the Fed saying that they're raising interest rates this year, they also informed us that they will be selling their mortgage bonds. And as you know, I like to try to keep things as simple as can be. So the Federal Reserve has been buying $40 billion worth of mortgage-backed security bonds every single month. Now, a quick oversimplification of what's happening, so we're all on the same page, is as follows. When someone gets a mortgage, the bank typically bundles up that single mortgage with other like mortgages and sells the bundle of mortgages as a mortgage-backed security to an investor. Well, banks have been able to provide a lot of people with mortgages because banks knew that they had someone to buy these mortgage-backed securities. So although there was a big supply of mortgages being created, the banks knew that they had an end buyer, so the supply never outpaced demand. And the buyer was the Federal Reserve. They were buying $40 billion worth of mortgage-backed securities, and they said they're going to stop buying as much. Well, if the Federal Reserve stopped buying as much mortgage-backed securities, that means there will be an increased supply of mortgages for sale, thus causing banks to increase interest rates higher in order to make that bundle of mortgages more attractive to other investors. But to add to all of that, the Federal Reserve didn't just say they're going to stop purchasing mortgage-backed security bonds. They also said that they plan on selling the ones that they've previously bought. So you want to talk about being doubly screwed over? Yes, interest rates could go up significantly faster and much higher than we initially expected. Let's take a quick look on how this all might impact you. For starters, as I said, interest rates will go up. The last time the Federal Reserve sold bonds was around Q4 of 2018, and interest rates at that time were right around 4.8% according to Freddie Mac. And during that time, homes started to sit on the market longer. In fact, let me make this a little bit more personal for you. The home that I'm sitting in right now, that I'm filming this in, sat on the market for 143 days before we bought it in 2018. So the increased interest rate will cause there to be less buyers on the market, and in turn will cause more homes to sit on the market longer. But before you get too excited, let's see if prices went down in 2018. According to the Federal Housing Finance Agency, home prices actually went up 1.1% in Q4 of 2018, and in all of 2018, the entire year, home prices went up 5.7%. So based on history and data, I do not see a crash in 2022, but if the Federal Reserve continues on their current path, I do see a significant slowdown in housing sales and prices will start to level off. Now that is good news for those of you wanting more inventory to choose from, because homes will be sitting on the market longer, so you'll have more to choose from. But to those Americans who feel priced out of the market, you will continue to be frustrated because it'll be harder to get pre-approved for the increased home prices because interest rates have gone up, thus decreasing the amount of home you can afford. And during this time, banks will be more hesitant to give out mortgage loans because they can't readily sell them as quickly as they did for the past 2 years. Let me know how you feel about the current housing market, and be sure to subscribe to the channel for more real estate news. I'm Sir Ashley. Talk soon.